So that leads us to our next set of questions. So how much should you allocate to alternatives? And like we just said, do you want to take it from stocks or bonds? And does this really help? I mean, does this help a portfolio? Well, let's try to now focus at the portfolio level. So what we have is here is two pie charts, and comparing the two pie charts. The first pie chart is your very basic 60% stocks, 40% bonds. So we have 60% in U.S. stocks, 40% in U.S. bonds. So this is your traditional diversified U.S. portfolio. What we've done is taken this portfolio and carved out room to put 20% in the 9 alternatives. And just to keep it real simple, and what we did here is we equal weight those 9. So each 9 works out to about 2.2% in each of the 9 strategies. And so if you carve out the 20% here, we took it proportionately from stocks and bonds. So instead of being 60% in stocks like we were before, stocks is now 48%. U.S. bonds dropped from 40 to 32%. And then we have the 9 strategies, alternative strategies, to get to our 100. So and this is just an equal weight example. What we do is have different weights, but I wanted to just keep it simple for this presentation. So here what we have is back to our risk-return scatter chart, but instead of looking at individual alternatives, we're now looking at portfolios. So this is the whole package, if you will. So the first line, the first series here, the solid symbols, these are the portfolios with no alternatives. So the first one here, this is your 60-40. So this is 60% stocks, 40% bonds, just like we saw in our pie chart. And the other bullets on here are proportionately increasing a stock. So this is 60% stocks, 70% stocks, 80% stocks, and then going the other way, 50% and 40% with the other part in bonds, obviously. And so this is a traditional, you can call this an efficient frontier, if you will, where depending on your risk tolerance, you might like one portfolio over the other, because as you go from 60% stocks to 70, you increase your risk, but you're increasing your return, because you can see that the return gets higher as you add more and more stocks, right? So the 80% stock portfolio here has a high return, historical return of about 9.5%, where the one with 60% stocks was making less than 9% historically. Okay, so that's the traditional way. Now what we did with the open symbols is took those exact same portfolios and carved out 20% for alternatives, taking them proportionately from stocks and bonds. And you can see in every case, the portfolios with alternatives are making higher returns, okay? And in most cases, they're actually doing so with less risk. Let's look at our 80% stock, 20% bond portfolio. When we add the alternatives, we increase the return because we're moving up. We go from that 9.5 to something over 10%. Okay, so that's a nice return at the portfolio level. There's a nice increase in return. But look, we also decreased risk. This portfolio used to have risk over here a little bit more than 12, and now it's getting pretty close to 11. So the risk went down because we moved it to the left, and the return went up. So this portfolio is, we use the phrase, is clearly superior to the portfolio without alternatives. Higher returns and lower risk. That's great. Every one of these is in the same situation. Everyone has higher returns, and all but the bond-heavy 40% equity model actually have lower risk at the same time. This one has slightly higher risk, but in all cases, higher returns. So in summary, what we want to show is that alternatives help diversify a portfolio and therefore help increase return, reduce risk, or as we just saw, quite possibly do both. And the liquid alternatives that are now available resolve many of the issues that we've seen with traditional private hedge funds. So all the disadvantages of the way we used to have to access these alternative strategies have generally gone away when we've switched to liquid alternatives. Now here's all the legalese our compliance department requires us to show. And what I've also done here is I've listed the source of the return data you've seen in the tables and in the charts of each of the indices. So if you want to know where I'm getting that information, that's where that's coming from.